welcome to this very special edition of the World Outlook for 2017 with me, Tanvir Gill. My guest today on the show is none other than Aswath Damodaran, who's a professor of finance at Stern School of Business at New York University, where he teaches corporate finance and equity valuation. He's best known as author of several widely used academic and practitioner texts on valuations, corporate finance and investment management. Professor Damodaran is widely quoted on the subject of valuations with a great reputation as a teacher and an authority on the matter. He has written several books on equity valuations as well as on corporate finance and investments. Professor Damodaran, great to have you on the show. Thanks very much for taking out the time to speak with us today. Well, let's start off by talking about your world outlook for the new year. Would it be as dramatic as the year 2016 has been?
Well, I think 2016 brought us two things. One is it brought us the realization that experts don't know what they're talking about. So anybody listening to this expecting me to say something profound should give up on it right now. Because I think if nothing else, 2016 taught us that when people forecast the future, they're asking for trouble. I think 2017 is going to bring more of the same because I think this is part of a long-term shift in markets and economies that people have not anticipated.
Right. The top discussion right now is around the outlook for the U.S. economy. The rally in U.S. equities and the dollar index pretty much reflect that, the world is extremely bullish as far as the U.S. economic outlook goes for the coming year. But some see it as a hope rally. Do you think reality will catch up?
Yeah, I think the most interesting thing that has happened in the last 6 weeks is what's happened to the T-bond rate, interest rates. Because I think for 7 years we've been told that the Fed sets rates and that until the Fed raises rates, rates are not going to go up. And what we've discovered in the last 6 weeks is actually how little power the Fed has over rates, that rates are going to go up if people's expectations change. And for better or worse, people's expectations have changed. Expectations about inflation and expectations about real growth. Is it ill-founded? It's too early to say. There are chances that these expectations will come to fruition, that you're going to see more growth and more inflation in the US. And that's, I think, part of what the bond market is reflecting. And I'm going to hold off on passing judgment on whether it's a hope rally or whether it's based on reality, because I think that there are real changes underlying what the new administration is planning.
Right, but in all the talk about Trumponomics, right, the focus will be on fiscal spending, pushing investment-led growth in the economy. Is that what markets are excited about?
Yeah. I tend to be a little cynical about how much power governments have to really make economies stronger. I think you can create a short-term push, but I think in the long term, the fundamentals have to shift. And for that to happen, I think you're going to start to see changes in the global economy. The US, it's not like 30 years ago where the US could be an island unto itself. The US is very dependent on global growth, and in particular on growth in Asia, in China and India, because I think without China and India providing that fillip to growth, I don't think you're going to see global growth come back. The US can't carry global growth for very long.
But do you believe, Professor Damodaran, that a 2%, potential 2.5% growth makes the U.S. economy look strong? In the last bull cycle, growth peaked at 3.5%.
Yeah. To be quite honest, 2 to 2.5% is the long-term growth. And I don't see growth in the U.S. economy going to 6 or 7%. It's not that kind of economy. 3.5% is a really good year, and 1% is a bad year, and 2.5% is the middle. That's why, when I said earlier that Asia has got to provide that extra growth, the U.S. economy is not capable of providing 6, 7, 8% growth. It's not. It's a mature economy. So I think that the 2.5% might become 3% or maybe 3.25%, but I don't see it jumping by very much going forward, even if good things happen.
So then what are the markets, the Dow at 20,000 signaling? Because the only earnings we've seen so far have been sponsored by buybacks. When and how will the structural push to earnings come to drive markets higher?
Exactly. I think that companies finally start to put back, and because for 6 or 7 years, U.S. companies have held back on reinvesting back into their businesses. As you pointed out, buybacks have provided a significant portion of earnings growth at U.S. companies. And that's not because investors are greedy and U.S. companies are short-term. It's because they look around and they don't see very many opportunities to make the kinds of returns on their capital they used to be able to make. So I think what's got to lead this process is companies have to rethink this notion of whether investments can make them money and earn returns that are sufficient to cover their cost of capital. And that's what we're going to have to wait and see whether the new year is going to bring a change in that in what companies do.
But Professor Damodaran, the top dollar question right now is how many hikes will the Fed do next year? What's your own expectation?
You know what? I've stopped caring about the Fed. I think this has been one of the most unhealthy obsessions of the last decade, is thinking that central banks set rates and looking towards the Fed every 6 months. I think the Fed has a lot less control over rates. I've described the Fed as the Wizard of Oz. I mean, the Wizard of Oz in the sense that its power comes from the perception that it has power. I don't think the Fed has that much power over rates. At the margin, they can move rates a little bit this way and a little bit that. To me, the Fed is like one of those leaders that follows the crowd rather than leads the crowd. So I think what they're going to do for the next year is chase rates up, because I think bond rates are going to continue to go up. And I think the Fed is just going to chase those rates up. So I don't think that the Fed is going to be the big driver of what happens to the US economy for the next year.
Right, but the T-bond rates, Treasury bond rates essentially are at 2.6%. I mean, there's enough talk in the market about those rates going as much to 3%, which would indicate a more hawkish stance by the Fed.
The T-bond, yeah, the T-bond rates are getting up to 2.6%, but that's not a bad thing. I think that to me, when long-term rates are 1.5%, 2%, that's a sign of a sick economy. To me, one thing that would indicate that we're back on a healthy track is for T-bond rates to get to 3 or 3.5%. And I have a feeling they're going to get there over the next year.
Right, but talking about the bond market, with rates going up, I mean, you've already indicated in the past that, the big bond bull market is coming to an end, and that'll hurt stocks as well. Is that the big risk facing us for the coming year?
I think that the big bull market in bonds is over, in my view. I think that it's been easy money for the last 8 years. Put your money in bonds, and every year you got that price appreciation. I think it's healthier for the economy to have 3% rates, because I think for the last 7 or 8 years, if you were a saver wanting to make safe income, the bond market was not the place you could go because rates were so low. So I think that a 3% rate will lead investors to make healthier choices. They won't be running after or chasing yield like they have for the last 7 years, investing in things they shouldn't be investing in, like master limited partnerships or high yield investments, which are not really good investments, but look attractive because that's the only place you can get reasonable returns.
So then what do you make of the dollar rally? Is it overbought? What happens next to the dollar?
No, it could be. I mean, I think anytime you see a rise this quickly, you're going to see some give back. So I think that you're going to see an adjustment back to a level which might be more sustainable. But by itself, I don't think as the dollar is overbought, and I'm not going to go out there and do some currency trade hoping to make money on the dollar dropping in the next year, because that historically playing games with currencies has never worked for me.
Right. No, the reason I ask you that essentially is because the dollar rally is being seen as advantage US, disadvantage EMs.
Well, I think at least in the short term, it's good for emerging markets because it makes their goods and services much more competitive in the global marketplace. So I think that when the dollar strengthens, the value of an economy in local currency terms when adjusted dollars becomes smaller. But I think that from a competition standpoint, if I were an Indian company, this is actually a good thing for me, not a bad thing. So I don't understand why it would be at least in the near term, a bad thing for these markets. I think it might actually work in their favor.
Yeah, but the argument there is how much will currency competitiveness with weakening in emerging market currencies really help in building exports if global trade continues to slow down and global demand remains sluggish? What's your view on that very matter?
Well, I think that if global growth continues to be low, everybody's affected, not just emerging markets. The U.S. is also going to be affected because if you think about it, 60% of the revenues of S&P 500 companies come from outside the U.S. So even if the U.S. economy picks up, I don't think it's going to pick up U.S. companies unless it leads to at least a partial resurgence in some of the emerging markets growing a little faster.
Okay, then let's talk about the technology sector and the tech valuations that keeps everybody busy thinking about where the tech sector is headed from here. You've written a lot about this subject. You divided the tech sector into new tech, old tech, as well as mature tech. Give us your own understanding of the big, wide universe of technology companies and how you react to the comparisons made of what we are seeing in the technology space today versus the 2001 tech bubble.
I think I'll remake the point I made in that post, which is old tech actually is among the cheapest of the US companies. I'm talking about the Microsofts, the Intels, because in my view, a 25-year-old tech company is like a 100-year-old manufacturing company. It is an old company. The young tech is where you see the pricing reflect a much more optimistic view of the future. I'm talking about the Facebooks, the Googles of the world. Are they overpriced? Perhaps, but I am not as quick as some to jump on the bandwagon of there's a bubble, it's got to burst, because I've been hearing that talk now for 4, 5, 6 years. And I think that some tech companies, some young tech companies are probably getting ahead of themselves, especially the really young tech companies. And that's okay. To me, bubbles are a sign of human beings overreaching, of being, trying to do things they can't do. So it's almost a feature, not a bug of these markets, that when you have really young companies, you're going to get a collective overpricing that's going to correct itself. That doesn't mean every one of these companies is overvalued. It does mean that collectively that they will get overvalued.
But Professor Damodaran, if valuations are stretched and expensive, then naturally the case for a correction gets stronger. It would lead to a shake-up as it did in 2001. Or do you think differently? Or do you think that this time is different?
There's no, I mean, there will be a correction. There's no doubt about the fact that there'll be a correction, but there's no easy way to make money of that correction.
Right, Professor Damodaran, I just want you to clarify, a correction or a crash? What do you expect?
Correction, crash. I mean, I prefer to use the word correction rather than crash, because I think that a crash basically is a 75-80% drop. I think there's more likely to be a correction than a crash, and that correction will be painful. It could be a 25 to 30% drop in pricing. But there's no easy way to make money off that correction because A, you don't know when it'll happen, and B, it'll not be universal. It won't be every tech company dropping by 30%. It'll be some of them, especially the ones without substance. So what you're going to see is a shaking out of those tech companies that deserve the prices they have, which are okay, and those tech companies where you have investors overreaching.
How can we not discuss the India outlook now? And let's talk about India at length. What's your own view about India versus other emerging markets into the coming year?
Yeah. I mean, as I said, I'm bullish about India simply because the competition is so weak, which is, Russia is obviously a commodity country now. There's very little going on. Brazil is in political trouble. China has its own internal issues with its economy. So I think from that perspective, India is healthy. I think the question is how, in 2017, how this will play out. I think that the pieces are in place for India to do well. That doesn't mean Indian companies are great investments. India as an economy could do well. And this, I think, is something worth remembering. 30 years ago, how an economy did reflected, how well the market did in a country reflected how well the economy was doing. I think there's an increasing disconnect now between how an economy does and how a market in that economy does. You see it in the US, you see it in Europe, you see it in much of the emerging markets. So I think India as an economy will be healthy. That doesn't necessarily translate into Indian markets being healthy. And I think that disconnect might be what throws people off, because for so long we've been told if you can predict what the economy will do, that's going to tell you which markets are going to go up and which markets are going to go down. But in the global economy that we're in, I don't think that's necessarily going to hold anymore.
Well, this year for FY17, we're expected to see flat earnings, zero growth, which has resulted in a largely flattish to weak performance for the markets, especially for the headline indices. Do you expect the same into 2017 as well? Flat earnings, flat market?
That would be my guess. I mean, as I said, I'm not a great market timer. That would be my guess, is that if you ask me to pick one particular scenario, that one is the most likely one. But I think that this is one of those cases where you can be hopelessly wrong in hindsight because something big can happen. So, and in fact, it's not even something big can happen. Something big will happen during the year because every year for the last 9 years, we've had a crisis of the year. Who knows what the crisis of this year will be and how it'll play out. So as investors, we have to be ready for the big event and how it's going to play out because it could be good for India, it could be bad for India. It depends on how that crisis plays out.
There has been so much push on reforms, whether it's a bankruptcy code, the GST implementation, the passage of the bill, demonetization. How have you seen these moves by the government to change the long-standing perception about India among foreign investors, wanting to really see the tough reforms being passed?
I hope it's a less unsettled year. I think that markets don't like too much change. So I think if there's change, it's got to be delivered in intense doses, and then you got to have a period where there's no change. I think the problem in 2016 was change got piled up on more change, got piled up on more change, which translates into uncertainty and risk, and markets don't like that. So if there's a wish I have for India, it's that there's change, but that change happens in a short period, and then you have a period of adjustment where the markets can get used to that change.
Fair point. Are you invested in Indian stocks? You've written extensively about Indian banks. What's the outlook there?
No, I haven't invested in an Indian company for a while. My distance from India makes me a little reluctant. And also, I have this deep aversion to investing in family group companies, which removes a big chunk of the Indian market out of my investment portfolio. So, but I think Indian banks actually on a relative basis, and this again becomes a common theme, everything is relative, are healthier than European banks are. I mean, when I look at Indian banks versus Italian banks, it's no contest. I think that Indian banks are going to go through their own adjustment period because I think they're going to face the same kind of disruption that financial service companies globally are starting to face from young startups as well as more unconventional ways in which companies have of raising money.
Right. And what would be a good measure to understand value in any investment? For viewers watching, what advice would you give them to pick reliable and undervalued investment opportunities?
My suggestion is start with the sectors that did the worst over the last year. To me, in investing, that's always been a right place to look for good bargains, is take the sector where people have given up. Take the sectors which have done the worst. I'm not, at the end of every year, that's why I look across markets and across sectors to see which the best and the worst performers are. And I'll be doing that probably over the next week, and I'll be putting it on my website in early January. So you can see within each market which sectors did the worst. And I wouldn't blindly invest in every company in that sector, the worst company in that sector, but that's where I go looking for intrinsic value bargains. A company that is in a sector that's been punished that probably didn't deserve to be punished as an individual company because it doesn't share many of the characteristics of the sector.
No, I understand. Like metals was the worst sector in 2017, turned out to be the best sector in 2016. Oil and gas recovered towards the end of 2016. Do you think the oil and gas sector could be the charmer in 2017 as well?
I think it's still a potential bargain. I think the biggest concern I have with oil and with portions of the oil and gas sector, those oil companies that have a lot of debt, I would avoid them because to me, even if I believe that oil prices are going to bounce back, but your company has to survive for you to be able to make money off that bounce back. And to make sure that happens, you want to avoid companies that are over-levered, that have too much debt.
Right. What does that do for your outlook on oil? 55, 60, do you think is a new reality?
Who knows with oil prices? I strap my safety belt on and I hope for the best. I mean, I think that I don't think $50 oil prices are sustainable in the long term. I expect them to go back. Whether that'll happen this year or 2 years from now, with the oil sector, it's always tough to tell because these cycles can run for really long periods, and we're still in a cycle where prices are consolidating rather than going up. So I wouldn't be surprised to see them go up to $80 a barrel. To be quite honest, if it's well within the realm of possibility.
Professor Damodaran, you've written extensively on family-owned businesses in India and their management structures. Also have said that a settlement is important on the Tata Mystery boardroom battle. How are you seeing this situation unfold?
I just think the whole affair has been a fiasco. I think that neither side has covered themselves with glory. I mean, I have nothing. I'm not pulling for either side in this battle. But I think that egos are involved, and that's natural when you have fights between personalities. But I think that what I get out of this fiasco is not so much a reflection on the Tata Group, which I think is, you can look at this and say this is awful for the Tata Group. But this to me is why family group companies have to be much more careful about separating family from companies, because I think that there's always going to be this instinct on the part of a family to step in and try to bring the family group to the family. And I think that's partly what you see happening here. It's not so much that Ratan Tata might have had specific issues with Cyrus Mistry, but the feeling that Cyrus Mistry was taking the Tata Group away from what he thought the group should be doing. So I think that neither side has covered themselves with glory in this process, and I don't think and I think it's been awful for Tata stockholders and Tata companies, because they're the ones ultimately bearing the brunt of this battle. Both sides have lost money, but I think shareholders are kind of the bystanders who are being affected the most by this fight.
Right, but you said that you won't buy a Tata Group stock. You've gone on record with that. Why is that? I mean, is that just a case with the Tata Group of companies, or you've just been put off by this episode for investing in any family-owned businesses in India?
Well, I've also admitted that any family group company I'm reluctant to buy into, because, the problem I have with family group companies, you seldom get a clean play on a company. You buy the company and you get this portfolio of other companies with it, whether you like it or not. In fact, of all the Tata companies, the cleanest play is actually TCS, because it's the company with the least in terms of cost cross holdings. So when I invest in TCS, I'm investing predominantly in TCS. I think that I would have the same view about any family group company. So this is not really about the Tata Group that I have an issue. It's with family group companies in general, and the kind of conflicts of interest that I think play out under the surface that I, as a shareholder, have absolutely no control over. And that scares me.
Right. This episode also brings to the fore corporate governance issues, Professor Damodaran, and I'd like to wrap up with that, faced by a lot of family group entities in India, wherein there lies a conflict of interest between keeping the interest of the business before one's own self-interest. How does one manage that, and how would you summarize this story and the perception it creates for big business groups in India, given the fact that the Tata Group is, of course, the poster boy for corporate India, with TCS and Tata Motors being formidable global brands? What do you take away from this story?
You cannot eliminate conflicts of interest. You can minimize them. And in the case of so basically what I would suggest is that family group companies start thinking about how you minimize the conflicts of interest. And I think one of the things they need to think about is these cross holdings that they use to enforce control. That's really the core reason for continuing with these cross holdings. They allow the families to control these companies with far less than 50%, maybe 15, 20, 25% of the shares. So I think families have to ask themselves whether they value control more or whether they value their businesses more. And unfortunately, when forced to pick between those two, it's amazing how often control wins out. You'd rather control a company that's worth less than give up control and have a company that's worth more. And increasingly, family group companies will be faced with that choice.
Right. Do you think that this case would serve as a good lesson for other such big family-owned companies?
Yes, but I think that you're always one bull market away from forgetting all your previous lessons. So history never moves in a linear fashion. It's 3 steps forward, 2 steps back. So it'll take a long time, but I'm hopeful still.
Fair enough, Professor Damodaran. Thanks very much for taking out the time to speak with us today. Really appreciate your views and your world outlook into the coming year. Wish you a very happy and prosperous year ahead.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.